Up till now, we've been dealing with a simplified version of the accounting equation where we simply said assets equals liabilities plus equity. But I need you to keep in mind that you can have 7 jillion assets, half a jillion liabilities, and half a dozen equity accounts. The most common equity accounts are common stock plus retained earnings, which is money that you earned, income that you earned and kept, minus dividends, plus revenue, minus expense. Now, if you look at it, that's net income, revenue minus expense. Dividends are paid out of retained earnings. That's the law. But that's the expanded accounting equation. Now, in my world, the world of accounting fools, we deal in terms of debits and credits. And you had a video, and I gave you a mnemonic device, DEAD, debits for expenses, assets, and dividends. I'm not trying to turn you into accountants. I'm trying to turn you into sophisticated users of accounting statements. So instead of going through the debit and credit dance, we're going to talk about all of these transactions in terms of what happens to our assets, our liabilities, and our equities. The first event in problem 17A, this guy invested $40,000 in cash, so cash goes up, and he bought common stock, so the common stock goes up. The next thing he did is he spent $2,200 to rent an office. So cash went down, expenses went up. Now let's take a look. He bought some equipment on account. So he's got the asset, $1,890, but he didn't pay for it yet. So it's a liability. And we're just going to continue to go right down this list. On May 5th, he paid $750 for this month's cleaning services. So his cash went down. See the little minus signs there? And his expenses went up. He has more expense. Then on May 8th, he got $5,400 for consulting services. So that's revenue. That's getting paid for doing what you do. So his cash went up, and so did his revenue. Remember, revenue is mission specific. When you get paid for doing what you do, that's called revenue. Then, on the 12th, he provided $2,500 worth of revenues to a client. He performed services for $2,500, so that's still revenue, but he didn't get cash. He got a promise to pay, accounts receivable. In accounting world, there is no difference between a promise to pay, an accounts receivable, and cash, and assets and assets and asset. I know that sounds kind of stupid. You can't go down to Delilah's and buy a cold one with an accounts receivable, but in accounting world, you can. Okay, now let's take a look. This is what, the 15th. He paid $750 for an assistant's salary for the first half of the month. So his cash goes down. Notice the little minus sign. And his expenses went up. Now on the 20th, it looks like he paid that $2,500, or he got that $2,500 he earned up here. So he doesn't go back to revenue. He already recorded the revenue. He reduces the accounts receivable and increases his cash. Now on the 22nd, he provided another $3,200 of consulting services on account. So his accounts receivable goes up. His promise to pay is his thing of value, and he earned it, so it goes under revenue. A few days later, those people bucked up, so his cash goes up, his accounts receivable goes down. Notice nothing happens to the revenue account. And then on the 26th, I got to flip the page here. He paid $1,890 for the office equipment, so he paid this bill. So notice nothing happens to the equipment account. He already recorded that. His cash goes down and his liabilities go down. He now owes less money. He has less money, but he owes less money. And then on the 27th, he purchased $80 worth of advertising in the local paper. I'm assuming that's not the New York Times. And he said, send me a bill. So his accounts payable went up. His advertising expense went up. Now remember, when an expense goes up, income goes down. Now on the 28th, let's see what happened here. He looks like he paid the other half of the salary for the month, same as this one. So his cash goes down, his expenses go up. Then on May 30th, he paid the telephone bill for $300. Did a lot of telephone expense. His cash went down. His expenses went up. Okay. I don't know what he's doing on the phone for $300, but I bet his wife don't know. Okay, now let's take a look. He paid $280 for the month's utilities. So his cash went down, $280. His utility expense went up. And then the last day of the month, he paid dividends to himself, the sole shareholder, of $1,400. So his cash went down, and dividends reduced the equity in the company. The value of the company went down. So when you total that up, that's the total value of the company. This is the asset side. There are all the assets. These are the liability accounts. And the remainders are the equity accounts. So, again, we have assets equals liability plus equity. That's taking a month's worth of transactions, breaking them out. Now, if we were doing official accounting speak, we would be saying things like debit cash, credit common stock. Credit cash, debit expense. But I don't need you to be debitors and creditors. I need you to understand what's happening to the business.